Hi, my name is Craig. I've operated in various positions in financial services over the years, including as an equity analyst, a discretionary portfolio manager, and in venture capital. By creating these videos, I'm able to assist CAIA candidates in passing their level exams and ultimately obtaining the designation. This is one of approximately 90 training videos found on mycourse.com that collectively total close to 120 hours of instruction. The information in topic 7.1 is from chapter 29 of the CAIA Alternative Investments textbook, which is entitled Cases in Tail Events. I encourage you to please note the disclaimers contained at the start and conclusion of the video. On my course is not in any way connected to CAIA or the CAIA Association. The Chartered Alternative Investment Analyst Association is a non-profit corporation and does not endorse, promote, review, or warrant any product provider's course material. The information in topic 7.1 is from chapter 29 of the CAIA Alternative Investments textbook. As the title implies, we examine unusual events. So we're considering things such as hedge fund collapses, which are really rare events. A tail event is a small probability of occurring. It is an event more than 3 standard deviations from the mean that could occur at both ends of a normal distribution curve. While you're likely to find these cases interesting, the purpose of putting it into the curriculum is to distill the events into the underlying central causes and to develop insights to better prepare for future events so as to prevent a reoccurrence. The learning outcomes for this topic all have to do with demonstrating knowledge. Firstly, of the effect of market forces in generating hedge fund losses. Secondly, of the impact of trading technologies in financial crises. Then you need to demonstrate knowledge of major fund failures caused by fraud. And finally, the 4 major lessons from the analysis of fund failures. So the first learning outcome is to demonstrate knowledge of the effect of market forces in generating hedge fund losses. To begin, we will discuss the collapse of Amaranth Advisors, the due diligence issues related to it, and the lessons learned from the case. Amaranth Advisors was started in 2000 by a trader called Nicholas Moenis. The fund was a multi-strategy hedge fund. A Canadian gas trader named Brian Hunter was hired in 2004 to head up the energy trading team, and the team included a lot of former traders from Enron. Hunter's strategy was to go long natural gas futures in the winter months when demand was strong, and to go short natural gas futures in the summer months when demand for gas was weak. And this represented what we would typically call a calendar spread. The problem was that the majority of the firm's returns were coming from this trading unit. It didn't really represent a multi-strategy fund as it should have. In 2005, Hunter made large directional bets on energy products. As a result of Hurricane Katrina, he bet that gas prices would rise. His bet was obviously successful and he made the firm $1.3 billion. Hunter himself received the bonus of $75 million. At its height, the fund managed more than $9 billion of assets in 2005 and it had annualized returns of 86%. In the following year, in 2006, Amaranth made a number of delta hedge transactions on natural gas future derivatives. These energy trades made up half of their capital. In 2006, they bet their natural gas spreads would widen, when in fact they narrowed, which they had what they call spread compression. This first bet lost them $1 billion. As a result of the losses, Amaranth sought capital to fund their positions, and so they liquidated other positions. In September 2006, Amaranth was betting on a widening of the spread. They were long March 2007 contracts and short April 2007, which is the summer month contracts. This never happened, and in fact the spread narrowed and massive losses were incurred. By Friday the 15th of September, losses amounted to over $2 billion. Amaranth was forced to sell their losing positions firstly to Merrill Lynch, then to their prime brokers JP Morgan, who didn't want to let them sell it to a third party, and also to Citadel, which was another hedge fund. And they sold them obviously at largely discounted prices, and they lost more than $6 billion on the gamble, which ultimately collapsed the hedge fund. So what lessons can we learn? Firstly, the impact of prime brokers. Amaranth's prime broker was JP Morgan, and they were able to block a successful rescue by Goldman Sachs by withholding Amaranth's collateral. They were interested in picking up that position for themselves at a lower value. Secondly, we should remember the importance of diversification of a multi-strategy fund. A multi-strategy fund needs to be diversified. In the case of Amaranth, over 50% of the fund was in one area, natural gas futures. This isn't considered to be diversified. Investors who originally placed their money in a multi-strategy fund were probably unaware of this change in risk exposure. So style drift is a major concern for investors. You always want your risk exposure to be aligned with the balance of assets in an investor's portfolio. Traders need to be monitored carefully, irrespective of their past track records and profit-making ability. In addition, care must be taken when traders are not in the same geographical areas as their parent company. Had Amaranth been vigilant, they would have discovered that Brian Hunter had lost his trading privileges at his previous employer, Deutsche Bank. Regulation. Being a hedge fund, Amaranth was less regulated than most investment entities. However, Amaranth also avoided further regulation by taking a large portion of their trades to the Intercontinental Exchange, or ICE, as opposed to trading them on the more regulated New York Mercantile Exchange, or NYMEX. As a fourth point, risk management. There were not sufficient risk controls in place at Amaranth. Amaranth had market risk, exposure risk, and was also highly levered. The size of the futures market. Amaranth's positions were so large that they controlled the futures market. And traders began taking positions opposite to Amaranth as they were aware that the positions were not driven by normal supply and demand factors, but rather by large-scale trading. Let's consider question 1 at the back of chapter 29 of the CAIA textbook. Were the losses to Amaranth Advisors investors to be expected, given the high risks of the fund's investment strategy? The answer is no, because Amaranth was a multi-strategy fund with a stated strategy that would not lead investors to expect such large losses. For example, external investors would not expect that 50% of its capital was dedicated to one specific market or trade. Amaranth had very large, highly levered and concentrated positions, but apparently had no formal stop loss or concentration limits. This suggests that Amaranth's internal people likely severely underestimated the probability of long-term and large unidirectional price movements against its positions. Here's an exam type question. Amaranth's trading strategy would have been profitable if which of the following had occurred? A. If spreads had tightened. B. If winter natural gas inventories had remained stocked. C. If weather conditions had become extremely harsh. Or D. If interest rates had remained stable. Well, Amaranth's trading strategy involved buying contracts with winter deliveries and then selling contracts with non-winter or summer deliveries. So the strategy would have benefited the most under extreme weather conditions, such as if there was a hurricane, a heat wave. So the strategy was essentially looking for spreads to widen. Instead, they tightened, forcing a margin call. So the answer in this case would have to be C. Another exam type question. Other than trades not moving as expected, which of the following are key issues associated with the demise of the Amaranth Advisors hedge fund? 1. Large position size. 2. Poor risk management. 3. Style drift. Or 4. Weak valuation. So there's a couple of option combinations there. But some of the key issues associated with the demise of Amaranth, if we think about it, it was that they took very large positions, more than 50% of their portfolio in one type of position. So they also had poor risk management. Their lead trader had his trading desk out of the country. There were no stop loss limits, and there was obviously an underestimation of risk. The third problem we know about is style drift. Amaranth was supposed to be a multi-strategy fund. However, its trade became heavily concentrated in the energy sector, particularly natural gas. And so the last point there, weak valuation, was not really a key issue. So the answer would be C for options 1, 2, and 3. The next case in a tail event is an interesting one, long-term capital management, LTCM. This was a hedge fund formed in 1994 by a team that had previously worked at Solomon Brothers. They found raising capital pretty easy because they had a fantastic reputation. Two of the team members were Nobel Prize winners in economics, Scholes and Miller. Even though they had these people with good reputation, the exact nature of the fund and what it did was still pretty secretive. Investors in the fund were locked in for long periods of time in order to avoid liquidation concerns. The founders themselves invested heavily in their own fund, and LTCM made excessive use of leverage. At one time, the leverage of assets over equity was as high as 28 times, and And so one of the key strategies of the fund was supposed to be a relative value strategy. This strategy involved identifying pairs of securities whose prices had moved away from each other. The strategy was to invest in these similar securities and wait for the prices to converge. So the strategy should theoretically reduce volatility as the investor is both long and short the same type of security. LTCM used their convergence strategy on fixed income securities. They believed that the spread between riskless and risky fixed income securities had widened and was going to converge in the future. LTCM also traded equity volatility by using equity options. When volatility was too high, as implied equity options, they would sell volatility until it returned back to normal levels again. But unfortunately in 1998, it was slightly unforeseen, but Russia defaulted on its debt. This sent the Russian inflation rate soaring, interest rates rocketed, and the currency, the ruble, crashed. It resulted in basically a contagion effect. Brazil and other markets were affected. There was a widening of credit spreads between government securities and all other fixed income securities due to a flight to quality. As a result, the credit spreads widened further instead of converging, and this widening obviously caused massive losses for LTCM. It was completely against what they expected. This general increase in volatility caused losses as a result of the equity volatility trades as well. So LTCM lost 44% of its capital in just 1 month. The firm had to start liquidating its positions in order to meet margin calls. Unfortunately for LTCM, they didn't have the capital to withstand the funding liquidity crisis. If they had greater capital reserves, they would have been able to hold out until convergence did occur much later. LTCM was bailed out by the Federal Reserve and 14 other banks to the value of $3.65 billion for a 90% stake of LTCM. So what were the key risks here? One risk faced by LTCM was model risk. LTCM assumed that their models and their historical relationships would persist into the future, but this wasn't the case. Another error made by LTCM was that they believed that correlations among risks do occur and that high severity events that occur infrequently are uncorrelated. This was of course not the case, as high severity events were followed by another high severity event. Russia was followed by Brazil, and other emerging markets were in turn affected, etc. LTCM was not as globally diversified as it appeared to be. Although they were invested in many different asset classes and locations, their investment strategy was in fact singular. Their premise was that all risk premiums and market volatility would ultimately decline. LTCM made excessive use of leverage. Over time, many imitators of their trades entered the market, thus making their leveraged positions even worse. When it came to liquidate their positions, LTCM found themselves acting as a market maker more so than a price taker. Being a hedge fund, LCTM's reporting requirements to the regulators was also very limited. So some of the lessons learned was that initial margin needs to be collected irrespective of who the counterparty is. Liquidation costs need to be considered when investing, and there needs to be greater disclosure of the fund's positions. Stress testing should be used when evaluating financial risk, and even the best investors can fail. A whole book has been written about this LTCM failure called When Genius Failed, because of the background of the founders of this hedge fund. So let's consider review question 2 at the back of chapter 29 of the CAIA textbook. What was the primary premise of long-term capital management's trading strategies? The answer is, the primary premise of LTCM trading strategies was the expectation that the spread in prices or rates between two similar securities would converge over time. LTCM would buy the cheaper security and short the more expensive security while applying tremendous leverage, and wait for the spread between the two similar securities to narrow before closing the trades. The Carlyle Group set up a hedge fund called Carlyle Capital Corporation, CCC, which traded on the Amsterdam Stock Exchange. The Carlyle Group retained 15% of CCC. The investment strategy was to borrow at short-term rates and invest in long-term AAA-rated mortgage bonds through things like Freddie Mac and Fannie Mae, which are government-sponsored entities. The expectation was that these bonds were low-risk bonds, being AAA rated. On its own, obviously, that strategy isn't going to make much money unless there's a very steep yield curve. So how did they make their money? Well, they leveraged up and right to the point of going almost 32 times. So CCC's investment of $700 million allowed them to invest in assets worth $22 billion. The concern of this level of leverage is that any small price reversal, it only needs about a 3% move against it, and it could wipe out the entire equity of CCC. When these mortgage assets lost value in 2008 during the housing crisis bubble, the lenders began to take over the collateral of CCC. This led to the insolvency of CCC, and within a short period of time, investors lost their entire investments. So, yet another casualty of 2008 that probably doesn't get the same attention as Lehman Brothers and Bear Stearns does. So the lessons learned is even when dealing with assets from a government-sponsored entity, which implies some sort of guarantee, there is still market and liquidity risk. When the levels of leverage are far too high, results can be disastrous. In times of crisis, the hedge fund cannot rely on the creditors or the prime brokers to come to their assistance. In fact, sometimes it's quite the contrary. So the review question from the back of the CAIA Alternative Investments textbook is, how could Carlyle Capital Corporation suffer large losses from a strategy dominated by long positions in AAA rated securities? Carlyle Capital Corporation used significant leverage in order to initiate its long positions in these AAA rated securities. When the creditworthiness of the AAA rated mortgage securities came under question, the value of these mortgage securities decreased, and CCC received margin calls from its creditors that it couldn't fulfill. It is alleged that the AAA ratings were undeserved. So when returns started to decline, many managers attempted to maintain the levels of return by increasing the levels of leverage. However, the strategy can prove to be catastrophic when markets turn down and liquidity freezes up. Based on this, investors should not only look at the levels of return, but also the levels of leverage within each investment strategy. The first concept to understand is the capital structure of the entity. This is derived from the basic formula that assets is equal to the capital introduced to the fund, or the equity plus any liabilities, which is the dangerous part of the equation, the liabilities. For example, if a fund holds $1 billion in assets and the equity or capital introduced to the fund was $100 million, then $900 million represents the fund's liabilities or the leverage. So if you look at this, the leverage will actually be 10 times. At this point, we're encouraged to consider two important equations and also keywords or definitions that we'll need to know, namely firstly return on equity and then return on assets. Return on equity is return on investors' capital. Basically, it's profit after financing costs expressed as a percentage of equity. Return on assets is defined as profit before financing costs and taxes expressed as a percentage of assets. So let's consider this very important equation. It's an equation that you're just going to have to memorize, and it can be used to solve for leverage, or it can be used to solve for the return on equity or return on assets. The L in this equation is leverage. The R is the interest cost of the leverage, and obviously the ROE and ROA we've just discussed. Here's a typical exam type question to use as an example. The investment strategy of a fund generates an annual return on assets of 8%, while the fund's objective is to attain an annual return on equity of 28%. Which of the following represents the leverage ratio the fund must apply to attain this ROE, given that its borrowing cost is 3% per year? To consider how the calculation needs to be done, we just need to go back to the formula and plug in the relevant numbers. The 8% times L equals 0.08 L minus negative 3% times L is equal to 0.03 L, and then negative 3% multiplied by negative 1 will become positive 0.03, and that's simply because a negative times a negative gives you a positive. Now the next mathematical step is to take the positive 3% we've just calculated to the other side of the equation, so that the positive 0.03 becomes negative 0.03. Then we get 25% or 0.25 on the left side of the equation, and we subtract the 0.08 L from the 0.03 L, or the 8% L from the 3% L, and we get to 5% L. So to solve for leverage, we divide by 5% on both sides. So L is equal to 25% over 5%. In other words, L is equal to 5. Therefore, coming back to the question, the correct answer out of those options would be B. The leverage is 5 to 1. The same equation can be used to calculate the return on assets if that's the missing variable. So in this example, the question is, the fund managers of XYZ hedge fund use a leverage of 4 to 1. The current lending rate for the fund is 5% and the targeted return on equity is 25%. What return is the fund expected to generate? Now the question of what return is the fund expected to generate is actually asking about return on assets, ROA. So in this case, the R in the equation is 5%, the ROE is 25%, the L is 4, and so we need to solve for ROA. So again, we go back to the equation that we just need to memorize, and we plug in the numbers, the 25% for the ROE, 5% for the R, or the interest rate, and we substitute 4 for L. And following normal mathematical principles, you end up taking the 0.15 or the 15% across the equation, divide both sides by 4 to get ROA that's equal to 40% over 4, or ultimately 10%. Pause the video if you need to go through these calculations more carefully. The last part of this first learning outcome is to identify and describe behavioral biases and their potential effects on risk taking. So we need to define the phrase behavioral biases, which are tendencies or patterns exhibited by humans that conflict with prescriptions based on rationality and empiricism. There are two main types of categories or biases. The first is a cognitive bias, which is faulty thinking. The second is emotional bias, which has to do with reasoning influenced by feelings. This discussion falls under the broad term of behavioral finance, which has to do with the study of how people actually make investment decisions, as opposed to how traditional finance prescribes how decisions should be made. According to traditional finance, individuals are always rational and markets are always efficient. In other words, prices incorporate all available and relevant information. However, the reality is obviously quite different. Assets are often mispriced, and analysts often underestimate the risks associated with what they deem to be an opportunity. So the CAIA textbook describes behavioral finance as a study of the potential impacts of cognitive, emotional, and social factors on financing decision making. For example, confirmation bias is the tendency to disproportionately interpret results that confirm a previously held opinion as being true. For example, an analyst might locate an investment opportunity that's based on a false prediction of high profitability. Maybe the analyst has made high profits on this instrument or this particular security or type of trade in the recent past. A confirmation bias would cause the analyst to decide that the reason for the finding is that the opportunity will be highly profitable, rather than to conclude that the prediction was made in error. In other words, we look for reasons to support an existing view or opinion that we hold to be true. Anchoring is very similar. The analyst's belief that profitable trading opportunities exist in a particular market could be as a result of this anchoring, this tendency to rely heavily on previous beliefs. An analyst observing past successful searches for profitable trades may disproportionately expect that new opportunities will be found, despite knowing that market conditions have changed. We also tend to anchor to a particular level or price. So if a share or security was above $100, we would anchor to that price when it's maybe $95, thinking that it'll go back to the previous level, although that may have nothing to do with the true valuation of the company. It's just to do with our previously held beliefs. Confirmation bias and anchoring are examples of behavioral biases. The behavioral biases are generally viewed as important explanations for some investment behavior, and they often conflict with rational long-term investment decision-making. In due diligence analysis, these biases should be presumed to affect both the fund managers being evaluated and the analysts charged with performing the analysis of the funds. The primary methods of combating errors in decision-making due to behavioral biases are to rely on evidence, including academic research, and to use industry best practices that are based on careful analysis of empirical evidence and theory, rather than to rely on one's own emotions and judgment. So let's consider review question 4 at the back of chapter 29 of the CAIA Alternative Investments textbook. The question is, how is behavioral finance related to fund failures? And the answer is, behavioral finance attempts to explain the potential influence of cognitive, emotional and social factors in opposition to evidence and reason. For example, these factors can lead fund managers to take enormous risks to try to offset losses in the face of evidence that a strategy is simply not working. These biases can also lead investors with overconfidence to select managers that are more likely to commit fraud because the managers are playing to the emotions of the investors. An exam type question: which of the following statements regarding behavioral finance and behavioral biases is correct? A. Behavioral biases refer to social biases, not emotional biases that cause people to act in an irrational manner. Well, that can't be true because we know it does have to do with emotion. B. Anchoring can cause fund managers to be overly confident that markets or strategies will always perform well. Well, that sounds true to me. C. Confirmation bias refers to instances where fund managers assume good companies are good investments. D. Behavioral biases refer to emotional biases but not cognitive biases that cause people to act in an irrational manner. If we look, the correct answer will have to be B because that's the most correct. Anchoring refers to the fact that fund managers seem to be anchored to a value or belief that if it has a gravitational pull, these managers will be failing to account for the fact that the investment environment has changed. They stick to their firmly entrenched belief. So unlike capital markets theory, behavioral finance assumes that individuals can act in an irrational manner due to behavioral biases. Behavioral biases include emotional, cognitive, and social biases that cause people to act in an irrational manner. Confirmation biases refers to instances where individuals more heavily weigh information that agrees with their beliefs or discounting information that disagrees with their beliefs. We're going to look at the next learning outcome 29.2, which requires us to demonstrate knowledge of the impact of trading technologies in financial crises.